That number on the gas station sign, it's not the price of your commute only. It's a live feed wired straight into inflation, the Fed, and every stock you own. Today I will show you the exact chain that connects one barrel of oil to your portfolio. This is the market thesis. Let's go. The domino effect. Oil doesn't hit the market directly. It topples 5 dominoes in order. Crude knocks into CPI inflation, which forces policy interest rates, which reprices equities, which lands on your portfolio. Miss one link and the whole thing looks like a magic. So let's walk the chain. The cost of everything. Domino 1. Oil is the baseline cost of everything physical. One barrel splits into a gasoline, diesel, jet fuel, and plastics. That's why jet fuel is over 30% of an airline's cost. Diesel is up to 40% of trucking, and energy is a quarter of what it costs to run a farm. Crude goes up, all of it goes up. The pass-through timeline. Now, watch how it becomes inflation. Fed says a 10% oil spike ripples out over 2 full years. First, rockets. Pump prices jump instantly, energy inflation pops 2.3%, then feathers. Those costs drift slowly into food, then into everything else, fast up, slow down. The psychology anchor. Here is the oil secret weapon. Psychology. Gas is only 4% of the inflation basket, yet it drives 40% of how people feel about inflation because it's the one price you see every single day. In May 2026, sentiment crashed to a record low, driven almost entirely by that number on the sign. Domino 3, the pivot. High oil traps central banks. It slows growth and raises prices. So they choose branch A. Look through it. Hold rates. Branch B. Panic. Hike. Crush. Demand. Right now, the Fed and the Bank of Canada are both looking through it. For now. The exporter asymmetry. Here is the twist. The small oil spike hits countries in opposite direction. For the US, an importer, it's a tax. For Canada, an exporter, it's a windfall. GDP jumps 0.5%. Same barrel, opposite outcome. Which is why their central banks react differently. The gravity of interest rates. Domino 4. Rates crush stocks. Through gravity, a stock is worth its future earnings in today's dollars. Raise rates, and those future dollars shrink. Goldman says every 1% jump in yield compresses valuations 7%. Tech and growth get hammered. Energy and utilities surge it off. The 2022 stress test. We saw it live in 2022. Nasdaq down 33%, S&P down 19%, but S&P Energy up 65%. The only green on the board. Wealth didn't vanish. It rotated from oil consumers to the oil producers. And Canada's TSX down just 6%, a firewall. The vital loans demand versus supply. Oil up means stocks down is a myth. It all depends on why oil is rising. Supply shock, war, fear. Oil up, stocks down. Demand shock, booming economy. Oil up, stocks up. Same chart, opposite meaning. Always ask why. What is the reason behind this? The Canadian structural hedge. So, how are you positioned? The S&P 500 is just 4% energy, wide open to an oil spike. The Canadian TSX, nearly 18% energy plus 31% financials. So, just by holding the index in bridge, Suncor, CNQ, the Canadian investors own a built-in firewall against energy inflation. The decoupled petro currency. One myth to kill. The loonie is not a pure oil play. It used to move in lockstep with crude. Until 2017, when it broke three culprits: the WCS discount, Fed versus Canada rate gaps, and the shrinking oil exports, the petrocurrency link is real, but no longer reliable. The 2026 Investors Dashboard. Cut the noise. Watch this 5. WTI versus Brent. Geopolitical risk. The WCS discount, the Canadian profits, the loony Fed versus Bank of Canada policy. Bond yields, rate expectations, and pump prices, the fastest leading indicator of the next inflation report. 5 metrics, that's the whole engine. The macro engine. So, back to where we started. The number on the gas station sign isn't your commute. It's a live readout of inflation, policy, and your portfolio all at once. Crude to CPI, to policy, to a stock, to you. One clean chain. If this reward how you see the market, hit subscribe. Market Thesis breaks down the mechanic behind the headlines. See you in the next one.